All right, now to our first conversation. We've seen in recent years, African nations have faced growing economic pressures due to rising global interest rates and escalating debt burdens. And, we've seen some interest rates stay elevated. For the central banks now in particular, we see the U.S. Federal Reserve, they've kept, rates steady, but still elevated. Well, we see the European Central Bank and the Bank of England, they've reduced rates recently. Well, let's hear more now from Patrick Ba Abankwa, as a global investment consultant. Join me via Zoom from Ghana. Great to have you on the show.
Thank you very much, and good afternoon to you.
Fantastic. So, definitely, we've hearing a lot about debt issues now, even in the developed countries and advanced economies at this point. So it seems debt is not just for Africa. That debt problem is not African alone, at this point. But how would you say elevated global interest rates? How would you say they're affecting African sovereign debt sustainability? And which countries do you think are most vulnerable in Africa right now?
Thank you very much. I think that the elevated global interest rates, as you rightly said, which are driven by tightening monetary policies in advanced countries, have significantly increased borrowing costs for a number of African countries. And I think this leads to some debt sustainability concerns. If you look at, for example, higher refinancing costs, countries that are rolling over their Euro bonds face steeper yields, especially if you look at Ghana's 2022 Eurobond yields, which spiked to over 20%. It also leads to some currency depreciation. So a stronger dollar increases the local currency debt burden. Example is, we all know of the Nigerian naira and the Kenyan shilling, which have faced some sharp declines over the period. And then if you look at reduced fiscal space, debt servicing crowds out some critical spending on health, education, and some infrastructure. If you look at the most vulnerable countries, I think that if you look at high debt to GDP ratios, countries that have been hit so hard, we have Ghana, we have Zambia, we have Ethiopia, they have suffered the most. If you look at low foreign reserves, then you are looking at countries like Malawi, Zimbabwe, and then if you are looking at countries that are having dependence on commodity export, then you can be looking at countries like Angola, DRC, due to their volatile revenues. I think that the Fed and the ECB rate hikes have made international capital more expensive, in my view. And I think that pushing some African sovereigns into debt distress. Zambia and Rwanda, Ghana have already defaulted, while Kenya now spends over 60% of their revenue on just debt servicing. I think that the worst hits are countries with weak foreign or forex buffers, and those that have maturing new euro bonds like Ethiopia, which is, as we speak, they are seeking restructuring with the G20 common framework.
All right, so definitely you did mention foreign reserves at this point not being able to create that buffer for most of these African currencies. But from in your view, which country in Africa would you say is doing better than most when it comes to that foreign reserves?
I think if you are looking at countries that are doing better in Africa, you're also talking of countries like South Africa, which is still very strong when it comes to their reserve. Countries like Egypt. Egypt is still up there when you talk of countries that have been able to build their reserve because of how strong their economy is fundamentally, how they are able to institutionalize the use of their local currency. They don't rely so much on foreign currency for a number of these trade agreements. So these are countries that historically have shown that they are very strong. If you look at globally, of course, we are looking at the countries like China. China is still a very strong international horsepower when it comes to currency buffering. So on top of mind, these are the countries that I can see are doing the right things and have a strong foreign reserves to match up against any global shocks that will happen.
Right, and most of the time, you'll be looking at a country like, say, Egypt. I think that's about 40 to $45 billion. There we see Nigeria ranging between 33 to 35 billion dollars. So, looking at most of the top African economies at this point, what would you say would be that sweet spot, for foreign reserves? Should we be looking at maybe 60 billion, $100 billion?
I think that the quantum would depend on how big the economy is. You talked about Egyptian economy, you talked about Nigerian economy. These are big economies in Africa. You can't compare their buffer to countries like Ghana, countries like Rwanda, countries like Uganda, which in terms of the size of the economy is not as big as the Nigerian economy or the Egyptian economy. I think that what each country should do is to ensure that they have a buffer that is able to give them currency stability. If you have a buffer that gives you currency stability and you don't need to now be chasing after foreign currency for your trade in your country, then eventually you're able to strengthen your currency. As we speak, some countries have been able to rebound in terms of their currency appreciating against the dollar because of the global challenges that the dollar is facing. But other countries are still suffering as we speak. I know a country like Nigeria, you are still battling with depreciation of your currency against the dollar. So it's all about how big the economy is and the minimum that you need. I think that if your economy is very big, you should be looking around maybe 50, 60, 70 by way of your reserves to fight against any global shocks that may come your way.
All right, definitely. Most of these countries trying to beef up that reserve, going forward. But what would you say are the major obstacles in, debt restructuring negotiations between, African nations and some of their international creditors at this point? Would you say such negotiations are going well since this is a season, everybody is looking for some kind of deal or, negotiating on behalf of different countries at this point?
I think that the challenges that most African countries have experienced within this period, you can look at it in various ways. One, you're looking at the creditor coordination problems. Countries like China, which is now basically Africa's largest bilateral lender, prefers bilateral deals with sovereign states, while the private bondholders resist haircuts when it comes to some of these agreements. For lack of transparency is also, for me, one of the reasons why these challenges persist, because there's usually non-disclosure clauses in these Chinese loans, which complicate fair burden sharing. Again, there's also divergent interests. Multilateral lenders like the IMF, World Bank, they like to prioritize austerity, whilst governments face political pressure to maintain their spending habits. So these are some of the challenges. Of course, you look at the legal hurdles. So if you look at the collective action clauses in Eurobonds, which sometimes make restructuring a bit lengthy. You pick a country like Zambia, their 2020 debt default outlook, which was 3 years plus to resolve. It took a number of years for them to resolve that particular discussion. Ghana were lucky to go about a year and a half to resolve some of these legal battles. So I think that these, for me, are some of the challenges that goes with some of this burden sharing that goes on when it comes to restructuring of the loan agreements. Of course, we all know that the Paris Club sometimes step in to support some of these countries. G20's common framework also needs some reforms to enforce faster and fairer resolutions when it comes to some of these discussions.
All right, so definitely reliance has become a major issue with some countries relying heavily on just one export, commodity, or just over reliance on just one source for major things. How do you think African economies can reduce reliance on maybe foreign borrowing by maybe developing a deeper capital market? We know most proponents have said that the capital market can help when it comes to, funding choices there. What do you think?
I think that, first of all, yes, it's good that we look at other sources of reform. But I think that structurally, we need to reform how we build on some of these things. First of all, we need to be able to strengthen our pension and insurance sectors. Because in those foreign countries that we go for these loans, what saves and helps them to build funds to give out as loans is the pension sector. So I think that in Africa, we need to strengthen our pension and insurance sector so that we'll be able to mobilize long-term local currency funding. And for me, that is critical for us. Then again, we need to look at how we can improve our macroeconomic stability. High inflation continues to be a deterrent when it comes to institutional investors. So investors who want to go into investment look at the inflation that is quite high, and that informs them whether they can go ahead with their investment or not. So I think that that is also a critical factor. Then we should also work on enhancing liquidity. Some few African markets have active secondary bond trading, like South Africa and Kenya, as some exceptions to that. But historically, we have some countries having low access to liquidity and active secondary market. So that's another area that I think they should be able to work on. Then there's also what we call the diaspora engagement. Here, you encourage citizens who are outside the diaspora to invest more in the country. Once they invest more, they bring foreign currency to strengthen the economy. And you look at a country like Ethiopia. Ethiopia's diaspora bond shows potential, but require trust building. So I think that all of these things can persist. Look at, for example, Rwanda's local bond issuers that they did recently. There was success for that. Yet, if you look at the broader progress, it needs central banks' independence and yield curve development to ensure that some of these things see the light of day over the period of time.
All right, and talking about diaspora remittances, we did see the lawmakers, in the U.S., mulling some kind of tax on, remittances leaving, the U.S. Definitely, that's. I know that still requires some, negotiations and all of that, but that would definitely be a big dent, to your plan there for diaspora remittances to help, in boosting most of these economies.
Sure, I agree with you, because the American market is basically looking at how they can strengthen their currency, create jobs for the people. So any money that moves out of the country, periodically they put in some impediment by way of taxes so that it accrues to their revenue base as a country. And I think that even if they decide to tax about 15%, 20%, they still have some funds coming to Africa to support our fragile economy.
All right, I guess we should be looking at Africa first at this point, sure, so we can, boost the African continent when it comes to reducing debt levels, boosting some of our buffers, external buffers at this time. So much to unpack there, but tomorrow we'll be getting the interest rate decision in Nigeria. We'll cover that and see if it will be another hold or maybe something different, coming out from the MPC right here in Nigeria. Thank you so much, Patrick Ba Bankwa, Global Investment Consultant, for sharing your thoughts with us today.
My pleasure, my pleasure.
All right, we'll take a break now. When we come back, we'll head straight to the markets with Will Ebong. That's in a moment. Just stay with us.